All right, looks like we are live now. So last week, Yelp released an economic impact report, and the report had some pretty shocking data in it. So Yelp last Wednesday released its latest economic impact report, revealing business closures across the United States are increasing as a result of the global pandemic. As of August 31st, 163,735 businesses have indicated on Yelp that they have closed, a 23% increase since mid-July. According to Yelp data, permanent closures have reached 97,966, representing 60% of closed businesses that won't be reopening. And for some anecdotal evidence, there's a local barbecue joint here owned by a celebrity chef and another investor who owns some other restaurants around the area, and they listed on Yelp that they're permanently closed. They shut down their website and disconnected their phone. So you know it's permanent then, that it is not temporary with that restaurant. Now, maybe this celebrity chef, this celebrity barbecue guy, Myron Mixon, who has a cable TV barbecue show, maybe he gets other investors, but the investors he was with on that venture for that particular restaurant are SOL, shit out of luck. Yelp last Wednesday released its latest economic impact report, revealing business closures across the United States are increasing as a result of the global pandemic's economic toll. And this is politicians, this is bureaucrats, these are people that are shutting down these restaurants for a long time. The rules are different in every city, state, and county. And yes, some of these restaurants could have made it if they would have been able to transition to carry out and delivery, but not all food is good for carry out and delivery. That's the problem. It's not all restaurants are conducive to that. Whereas like a pizza place is a lot easier to, or Chinese food is easier to do carry out and delivery than other types of food, maybe soups or a barbecue restaurant in this case. It's the freshness of the food. It's a lot different. And then also with these delivery service companies, you're paying through the nose in fees. I ordered some pizzas when I was eating unhealthy during the pandemic a number of months ago. I'm not eating pizza nearly as much now. I've cut it back an enormous amount. But initially I was ordering some pizzas through Uber Eats, and with all the fees and delivery charges, like one pizza and a couple other things, it was $60. It was nuts, with all the delivery fees and all the other surcharges. So it was insanely high. But these are politicians that are forcing business owners to adapt. This is not the free market. These are politicians forcing bricks and mortar retailers, forcing gyms, forcing restaurants to have to do crazy things just to keep open, just to survive. It's freaking crazy. And I get all these messages and emails, Jason, why do you talk about restaurants so much? Well, you must not be familiar with the U.S. economy, because a very large portion of the U.S. economy is based on service sector jobs. There are an enormous amount of adult Americans and teenagers. Well, there used to be teenagers. Now they're probably going to be robots, automated fry serving or burger flippy, the burger robot, or whatever the new burger flipping robots are going to be. But an enormous amount of adult Americans worked in bricks and mortar retailer, worked at mom and pop shops, and worked at restaurants as servers and bartenders and other service sector jobs. So that's why I talk about restaurants. That was, even though many Americans had 1 or 2 degrees, I have friends who had master's degrees, and they picked the wrong career path or just bad luck. They couldn't get the right job opportunity, and they were bartenders, and they were making a pretty decent living before the pandemic. So that's why I talk about restaurants a lot. Also, I'm pretty familiar with the restaurant industry, having worked a lot of summer college jobs at restaurants. Those were all my summer jobs when I was in college, were at restaurants. So as of August 31st, 163,735 businesses have indicated on Yelp that they have closed. That's down from the 180,000 that closed at the very beginning of the pandemic. However, it actually shows a 23% increase in the number of closures just since mid-July. I do not think it's a coincidence, because that's when the forbearance periods for a lot of loans, that is when the SBA loans started to become due, I believe, starting in August and towards the middle to late August, I think, and the beginning of September were when some of these SBA loans started to become due. In addition to monitoring, so these restaurants, I've heard anecdotally stories of some restaurants that didn't have carry-out business, that didn't have delivery business, and kept people on the payroll with SBA loans from March through July and August, hoping that things would rebound, hoping that the politicians and the central planners, the bureaucrats would reopen, would allow dining. But we have so many rules and regulations in certain, depending upon which area you live, you have certain politicians saying that a restaurant's only allowed to have 25% capacity in the dining room, and restaurants just don't, the economics of a restaurant just do not run that well with low capacity. For the restaurant to be profitable, it is very capital intensive. Restaurants have very low profit margins. When everything's working well for a lot of restaurants, they have 1 to 5% maybe net profit margins. Things are normally not the project economics for a lot of restaurants are normally not very well. And when things are bad, restaurants go from barely making a profit. Yes, they generate a lot of cash flow when they're busy at lunch and dinner, but then when things go bad, then they stop making any profit at all. They go deep losses. In addition to monitoring closed businesses, Yelp also takes into account the businesses whose closures have become permanent. That number has steadily increased throughout the past 6 months, now reaching 97,966, representing 60% of closed businesses that won't be reopening. Quote, overall, Yelp's data shows that business closures have continued to rise with a 34% increase in permanent closures since our last report in mid-July. End quote. Justin Norman, vice president of data science at Yelp, told CNBC. Yelp's September report marks 6 months since March 1st, the date that the company considers to be the beginning of the business crisis. In order to gather closure data, Yelp monitors changes in business hours or descriptions on its app, offering an immediate, localized view of the impact the pandemic has had on small businesses. Quote, despite the hard-hit small businesses that have certainly taken, let me repeat that. Despite the hard-hit small businesses have certainly taken, we've seen that home, local, professional, and automotive services have been able to withstand the effects of the pandemic better than other industries, Norman said. The data supports the trend that most consumers are choosing to stay home over patronizing establishments physically, as home and professional services such as landscapers, contractors, and lawyers, also home improvement, because look at the prices of lumber, and people are leaving the cities and they're buying a lot of homes in more rural areas or less population density areas like Idaho and Montana and the Dakotas, and further away from the cities. Establishments physically as home and professional services, landscapers, contractors, lawyers see a much lower closure rate than lawyers. That's interesting. I wonder why the lawyers are seeing a much lower closure rate than clothing stores and even home decor businesses. Auto and towing, maybe it's for divorce because people can't stand each other. They're stuck, because that's what happened in China. The divorce rate after months of lockdown in China and Wuhan and other areas, there was no baby boom. There was some babies, but there was no real baby boom. An enormous spike in new kids. Actually, the spike was in divorces because husbands and wives were stuck with each other so much that they couldn't stand each other, and the divorce rate exploded in China after the lockdown ended. Auto and towing services also reported a relatively low closure rate. Quote, consumers still need these services, Norman said. Quote, through the rise of virtual consultations and contactless or socially distanced services, these businesses have been particularly resilient during this time. Throughout the past 6 months, restaurants, bars, and nightlife venues have been hit the hardest by restrictions brought by the pandemic. 32,109 restaurants have closed as of August 31st. The number of restaurants forced to permanently close is slightly above Yelp's total average at 61%. Yelp has also noted that businesses already well suited for takeout, such as pizza places, coffee shops, and delis, which make sandwiches and salads and other things, are treading water better than other restaurants serving other types of food. The types of restaurants with the highest closure rates include breakfast and brunch places, sandwich shops. Oh, sandwich shops. That's interesting because you could get those to go. That's an interesting divergence there between delis and sandwich shops. That's like left Twix and right Twix. And Mexican restaurants. Norman noted, you can get tacos to go. I don't know why. I guess maybe they're not selling the alcohol then. You can't get the margaritas to go, or they're not as fun to go. You can get tacos to go, that's for sure. Norman noted that policy changes in the coming weeks and months could have an impact on whether these closures turn permanent. Quote, the continued rollout of indoor dining, especially in metro areas like New York City, will be worth watching, as it will be critical for businesses to maintain the right balance of practical social distancing and other responsible safety measures to ensure that they can stay open. But this is the problem. If a politician or bureaucrat says that the restaurant can only run at 25% or 30% or 35% capacity, the economics of the restaurant are not going to be good. I mean, the restaurant's going to run at a loss, maybe even a massive loss. And the clock is ticking on bankruptcy or the owners of the restaurant if they're not maybe just canceling the investment, not necessarily filing for bankruptcy, but just saying, I'm not wasting any more money. Bars and nightlife venues have also had a large impact from the pandemic as a business that can adapt as easily to outdoor dining or takeout. Despite being a sector that is 6 times smaller than restaurants, 6,451 venues have closed. The rate of permanent closures has increased 10% since July, now sitting at 54%. Retail saw a similar increase in permanent closures since July, rising 10% to a total of 58% indicated permanent. That's out of 30,374 closed retail businesses. This is really going to hurt commercial real estate, especially owners of like strip malls. It's going to absolutely hurt them because Amazon's not going to be interested in buying strip malls. Amazon's going to want to buy those very, very large malls and then turn them into distribution centers because they're right around where people live. There's a very short video on the Wall Street Journal YouTube channel that shows how Amazon for the last, 5 years or so has been just buying, after they bankrupt a lot of these malls, they've been buying up these large malls that go out of business and the stores leave for pennies on the dollar and turning them into distribution centers because that's right around where their customers live. The report showed a surprising month-over-month rise in permanent closures for beauty businesses. Since July, about 42% more businesses were indicated as permanently closed. Total closures for the beauty industry sit at 16,585, which is a 22% increase since July. Different states are also facing varying degrees of closures, and perhaps unsurprisingly, Yelp sees a correlation between states with a high number of closures and states with a high unemployment rate. Looking at closures because politicians and bureaucrats are not, and central planners and central bankers are not good at managing the economy. They're not good with bailouts. They're not good with wage and price controls. They're not good with rules, regulations, and taxes. They just make everything worse. They create even more distortions. I was going to wait till finish the article, but you have voted upon, in the state of Maryland, you have mandatory minimum wage increases kicking in now, starting on January 1st, 2021, that were just voted in during the pandemic. So by January 1st, 2025, the minimum wage will increase massively from $10 an hour to from $10.10 an hour up to $15 an hour for many small businesses in Maryland. So you have, and then the minimum wage is scaling up every year in between January 1st, 2020 and January 1st, 2025. I have a full article on this if you want to read it. But these are politicians who don't know economics, any real economics, and they are trying to buy votes because if people think that they're going to get higher wages, maybe they're going to vote for the politician then because it's a form of a bribe. And they're going to force higher costs on those business owners, on those restaurant owners, on those bricks and mortar retailers. But you also have the distortions of governments and central banks manipulating interest rates lower. So interest rates are artificially low and currency and credit is cheap for certain borrowers, not everyone, but certain borrowers. And so these large companies or restaurants, large restaurant chains, they can make the investments into automation. So the politician is trying to force costs higher, trying to force wages higher with minimum wage laws, which are wage and price control. And that's not deflationary. They're trying, yes, there's a lot of restaurants closing, but a lot of these restaurants, what I'm seeing personally, and I've heard this anecdotally and I've read a bunch of stories, is a lot of these different restaurants are starting to raise menu prices. They're starting to charge, not all of them, but they're starting to charge like pandemic surcharges now. I've seen it. People take screenshots of it. I've seen articles about it. I think New York City, a lot of restaurants have like a 10%, like $10 or more per bill pandemic surcharge on the bill. So they're adding all these extra things in there to raise costs. And you're going to have the deflationistas claim that all these restaurants closing is deflationary, and the politicians and the bureaucrats and the central bankers are all trying to pull these levers, whether it's with higher minimum wage laws or other things, to force prices higher. So this is just creating even more distortions. If you're familiar with the Austrian School of Economics, this fits in with the Cantillon effect, and you can have certain prices fall with the Cantillon effect. So if there's tons of monetary inflation and easy credit and manipulated interest rates, this incentivizes some businesses to invest in automation, to invest in robotics. But that doesn't mean the consumer who goes to these restaurants, who shops at these shops, is going to benefit from the business, the restaurant or the bricks and mortar retailer, not having to pay higher minimum wage laws. In fact, the prices might even go up. But you're still going to have the deflationistas claim that this is deflationary. So it's just creating even more distortions. Some of the costs, if there is investment into automation and robotics, some of those costs may fall. But that doesn't mean the consumer is going to benefit from a lot lower costs across the board, because we've seen this in the real world, that that's not how things play out. Just because the restaurants you eat at switch to touch screens and automation does not mean you're paying lower prices at those restaurants. It's been this way for a long time. Okay, back to the article. Different states are also facing varying degrees of closures. Perhaps unsurprisingly, Yelp sees a correlation between states with a high number of closures and states with a high unemployment rate. Looking at closures per 1,000 for each state, Hawaii has been hit the hardest, followed by California, Nevada, Arizona, and Washington State. Hawaii's unemployment rate sat at 13% in July. Well, yeah, a lot of tourists are not going. Not as many people are flying to Hawaii. Not as many people are going on cruises. And the state also heavily relies on tourism. Quote, due to the pandemic, these states were greatly impacted by travel restrictions and also face high rates of unemployment, said Norman. These states are also home to the hardest hit metros, including Las Vegas, Honolulu, and several of the largest California urban areas like San Diego, San Francisco, San Jose, and Los Angeles. Also, if there is a lot of investment with these artificially cheap interest rates that are manipulated down, incentivizing businesses to invest in automation and robotics to try to lower costs that way, and to try to get around forced higher minimum wage laws, you also could have politicians try to force more, and you're seeing a lot of people demand this now, a permanent universal basic income. So if you're having, on one hand, you're having investment with the cheaper currency and credit, manipulated interest rates, investments into robotics, and that would lower costs for the business on one hand, but also you have the money printed for a universal basic income with MMT, and then maybe they're going to put value-added taxes or a national online sales tax, or they're going to figure out new ways to tax. So even if there's a universal basic income, maybe if you eat too many calories, maybe if you eat junk food, maybe if you order the wrong things online, like the Chinese government does not like its citizens ordering Japanese porn. If you get caught in mainland China ordering Japanese porn, you get a penalty on your social credit score. And it's even worse if they catch you with a virtual private network paying for that. So there's all these penalties. Maybe that's what's going to come, and it's going to come in the form of taxes. But this would all be politicians and bureaucrats, central planners, just distorting things, playing around with wages and prices, playing around with rules, regulations, and taxes. And if there was a free market, there would be deflation. But I don't see a lot of evidence of real capitalism. I don't see a lot of evidence of a free market. I see more and more and more rules, regulations, taxes, interventions, and distortions. Okay, let me wrap up the article. Yelp has also noted discrepancies between large cities where closures are higher and businesses are not faring as well, and smaller areas which have proved more forgiving to small business. Los Angeles and New York report the highest number of closures. Los Angeles has seen 15,000 closures, half of which are permanent, and New York has seen more than 11,000 closures, with the highest rate of 63% reported as permanent. Quote, meanwhile, we're seeing we're actually seeing larger metros with fewer closures in the east, including Pittsburgh, Philadelphia, and Baltimore, Norman added. Ultimately, Yelp's data shows that Main Street is still feeling the economic impact of the pandemic, and many states and areas of business may not see a recovery soon. Quote, while it's hard to say what we can expect business closures, when we can expect business closures to stabilize, we've continued to see businesses successfully adapt to these uncertain times over the last 6 months, thanks to their own hard work, innovation, and local policy changes, Norman added. I would say in spite of the politicians, in spite of the bureaucrats, these hardworking small business owners and entrepreneurs have figured out a way to survive. Some of them, a very small percentage, are thriving, but many of them have figured out a way to survive, I guess barely for now. So the more that these PhD economists, these central bankers, these politicians, these bureaucrats, the more they intervene in the private sector, in a free market, the more distortions they have. Free markets are actually naturally deflationary. So the more capitalism we have, the more free markets we have, the more deflation we get. The more beneficial deflation consumers get. They get more goods and services for less dollars. So their purchasing power would, or currency. So their purchasing power would increase. That's what normally happened when free markets and capitalism were working with beneficial deflation. And I don't see a lot of benefits. And I don't see a lot of examples of free markets and capitalism working. I see more and more and more rules, regulations, taxes, red tape, regulations, more calls for bailouts with the airline bailouts, more distortions. People are calling for wage and price controls, higher minimum wage laws. There's going to be a lot more states, a lot more cities calling for higher minimum wages to offset people's cost of living going up for whatever reason. People are they've been demanding higher wages for a long time, so they may just kick them in. Probably not a good time for Maryland to raise wages, but they're going to raise them anyway. And then that may incentivize the business owner to switch to automation, more touch screens, maybe robotics, maybe Flippy or Frybot. I don't know what the fry flipping robot is. I know Flippy the robot burger, and I think there's a couple other ones. Flippy the robot burger. Flippy, people are going to laugh at that one. Flippy the burger robot does not need breaks. Flippy the burger robot won't demand higher wages, at least not yet. Flippy the burger robot doesn't need vacations. Flippy the burger robot won't come to work and cut corners and barely get the job done. But that doesn't mean that the consumer who's buying the burgers and fries is going to benefit from lower prices and deflation. The politicians are already talking about universal basic income, which can create even more distortions, and there's going to be even more currency and credit, probably chasing fewer goods and services, because there's going to be even less businesses. Unless everyone decides to start an online business and somehow we get a miracle and there's a lot of success with that. Okay, we got a couple super chats here. Thank you for the $9.99 super chat from Sparsh Paramu. Thank you very much for the super chat. I appreciate it. So all these things together are preventing deflation. Rules, regulations, taxes, wage and price controls, currency and credit creation. All these things are just creating an insane amount of distortions. Insane. Now, some prices, here's the thing about the Cantillon effect. It is very complicated. I have some more definitions if you want to read about it later. I've tried to simplify it behind the paywall for my Patreon account contributors and talk about it, but it's actually very complicated. It's one of the most important parts of the Austrian School of Economics. But with the Cantillon effect, it means with this currency and credit creation and politicians intervening and central planners intervening more in the control of businesses in the private sector, that the distortions, some prices might be flat or not go up at all or only go up a little bit. Other prices, like maybe asset price inflation, stocks, bonds, real estate, which the people in power seem intent on not letting the prices of stocks, bonds, and real estate fall for more than 8 weeks. There was from mid-February until the first week or so of April, the asset prices were in free fall. But I was writing articles about this while the asset prices were still collapsing for my Patreon account contributors, that they were going to do anything, whether that was job owning, whether that was enormous amounts of bailouts, stimulus plans, rules changes, anything, to try to make those bond prices, those corporate bond prices, those junk bond prices, and the stock market rally. They were going to literally anything that they could do, they were going to try. And that's basically what happened. So while everything was still crashing, I was warning people, hey, they're not going to let this thing crash forever without doing more and more and more, changing the rules, press releases that they're going to buy stuff, even if they wait 3, 4, 5, 6 months before they actually buy anything. They're going to do everything. The joke, I accidentally said kitchen soup one time. They're going to throw everything but the kitchen sink. They actually did throw the kitchen sink. Over $23 trillion in combination of central bank balance sheet expansion and fiscal stimulus since mid-February. And and a lot of that currency creation, a lot of it ended up in asset markets here in the US, because there's net capital inflows. There was a lot of them here into the US. Yep, we have the dollar index rallying. The dollar index is still in a tug of war, so at some point it was going to rally. The gold price is down a little bit. These gold companies, yes, the gold shares are correcting, but the underlying business, the operating business, are still doing superbly. The oil price is still fairly low. The margins for these gold and silver companies are spectacular, and it looks like the capital discipline, at least what the mining executives are saying for now, the gold mining executives are going to be very, very disciplined. Now, will that change a couple quarters from now, a year or two from now? Probably. Given the track record of the gold mining industry and all the bad deals that have been done over the last 12 years since I've been covering gold and silver stocks, the odds are at some point there's going to be a lot of bad deals, which is good for people who speculated on junior mining stocks. They're going to get big, big premiums. But for now, it looks like the producing gold mining companies are going to be pretty capital disciplined. So we'll see how long that lasts. Let's just say I'm not optimistic it's going to last very long given the track record of the industry. But yes, gold and silver temporarily on sale. Will they go lower? Maybe. We'll see what happens with the dollar index. Again, in my opinion, the dollar index is still in a tug of war. There was people telling me that the tug of war was over, the dollar was going to permanently slide, and I was like, maybe if the dollar index got way below 88. I think the one guy, David Hunter, I think the global macro expert who was calling me out on Twitter, what's his name? David Hunter, the guy who's like 30-something years of experience. He was making fun of me or something on Twitter last month, that he was like, oh, the dollar index will be down at 85 soon. He was saying that, like, the dollar index will be down at 85 soon. It's not going to rally again. He was saying that like a month or so ago. And I was like, I don't know, maybe. I was like, I think the dollar's still in a tug of war. He was like, no, I stand by my call. Okay. You have 30,000 Twitter followers. You got a bunch of retweets, like 100 retweets. I still think the dollar index is in a tug of war. Looks like for now, the dollar index still is in a tug of war. It's rallying a little bit. We'll see what happens. If the dollar rally ends and the dollar index slides again, gold's probably going to rally. Because normally, when the dollar goes up, gold goes down. But sometimes the dollar and gold can both rally. Sometimes the correlations do change, but not always. So there will be probably some really good sales for the gold stocks. There's a lot of articles behind the paywall for my Patreon account contributors on a lot of gold and silver miners, royalty and streaming companies. I'll probably put out an oil article in the next couple days. We'll see. Okay, one more super chat here before I go. Thank you for the $5 super chat, Abbey Road. He is also one of over 1,000 Patreon account contributors per month that I have. There is a lot of great content behind the paywall for only $5 a month. It is a really good value. There is a lot of good research that you will not find anywhere else. I really work hard. Okay, he says he just joined the live stream show. My oil stocks keep falling. Any idea of when they will recover? I've warned you not to buy a lot of oil stocks. You told me you bought, in emails, you told me you bought all these ones, and I was like, well, why did you buy them now? Because I've been warning people for at least the last 2 months that I thought oil could crash again. So I was like, I've been warning people for months now. Oil did have a big rally. I think the rally that oil had in, what was it, May? Late April, early May, was largely short covering, because we just haven't seen a lot of the demand come back. And I think China stockpiled an enormous amount of oil that they're not really using. And China's subsidizing a lot of car sales. So I think they're offering, like, it's even larger subsidy program than cash for clunkers in China. So I think a lot of the demand data that we've seen for gasoline demand, jet fuel demand data has not come back. And yes, oil rallied more than I thought it would. I thought oil would probably stay in would stay in a trading range from about $20 to $35 for a while, given where I didn't see an enormous recovery in the global economy and the demand coming back for a while. So we might be headed back to that trading range that I was suspecting before oil rallied enormously up to 40. So we could see oil in a trading range down from 20 to 35. And that's why I was telling people that I was in no rush to buy any oil stocks, that I was probably, after the oil rally and these oil stocks rallied enormously, there was probably going to be another crash. He says here, can we talk about the question you asked? And in a roundabout way, I did, because I don't think there's a good time frame. You might be looking at 6 months. You might be looking at 8 months. There's one oil trading firm that is bullish oil right now, the largest one in the world, I think Vitol Group. And pretty much everyone else that's doing the research is really, really worried that demand's going to collapse even more. That demand has not come back. That it's going to be at least 12 months, maybe longer. So in that case, then, the lowest cost producers will be able to ride out the storm. Some of the oil tanker stocks may benefit if there is a supply glut. Looks like there's a lot of oil tankers headed to China. So temporarily, some of these oil tankers may do well again. But again, I think that was just a trade. So you bought a lot of oil stocks way too soon. And you were emailing me about all the profits that you were getting. But that's the risk with oil. Oil is reliant on economic growth. Oil is reliant on a good economy. Oil is not a great inflation hedge. Gold and silver are monetary metals and are a good inflation hedge. If there is inflation, but the real economy tanks due to stagflation or taxes or or people are not traveling, people are not flying, the demand for jet fuel could collapse, and that could hurt oil. So I think oil will probably head back down. I know the Saudis are trying to enforce the OPEC plus production quotas, but a lot of the other news that's been coming out of the oil market is more supply could come back online, and a lot of the demand situation, a lot of the demand data I've seen for oil does not look good. So the next 6 months, maybe 12 months, could be pretty rough and pretty volatile for a lot of oil companies. Again, I was warning people when oil rallied, and I admit that I was wrong about how much oil would rally. I didn't think it would rally that much, but there was a lot of shorts. So now in hindsight, it makes sense that because there was that many people shorting when they covered that oil would rally more than I thought. But looking at the supply demand data, there is not a lot of demand coming back yet for jet fuel, for gasoline, for the oil market. So I think oil could be range bound. Maybe it gets down to high teens, low 20s for a while, and then bounces around between those levels and 35. So we'll see. The Saudis and OPEC Plus clearly do not want that, but there's also a lot of oil producers who want to bring more production back online. So that's the other problem. Oh, George Gammon's here. in the live stream show. So thank you, George. Good to see George in the live stream show. Haven't seen him here in a while. Okay, well, I think that's it. We're over 30 minutes. Surprisingly, my memory has not started to go yet. But I don't want to risk it. Because normally if it's around 30 minutes, I start to get migraines. I'm going to probably have a migraine, unfortunately, for the next 5 or 6 hours after this. Because that's unfortunately how bad things have been getting when I do long live stream shows now.